have a question for you.
Yes.
Rainbows and unicorns. When you read the Globe and Mail, you talk about it launched at $20. It's now worth 70 cents. Do you have colleagues that are considered, I wouldn't call them slippery, but like, is there a subset of your business that has people in it that are just ruthless three Monty card sharks?
Okay, so I'm not in investment banking anymore, and I think you're talking
Okay.
about those guys.
Well, of course, we wouldn't talk about valuators that way.
No, we wouldn't talk about valuators that way. We wouldn't do that. But well, you bring up an interesting question. And, you know, if I had life and time to do over again, I would want to do a PhD in finance. And that PhD, it would be based on the asymmetry of information in the Canadian capital markets. Right. So we have insider trading laws that says if you know something, if you're an insider to a company or you have specific knowledge about a company, you're not permitted to trade on it. And the US is much better at it. But you know, the Canadian regulators follow that idea, right? And that's where you're seeing your sharks is having better information than the market. And I think that there is asymmetry of information in the market. A lot of the business valuation principles rely on something called the capital asset pricing model. And that CAPM model has been around for a very, very long time. I can't recall the history to it, but one of the founding assumptions to it is that all information is known by all participants in the market at the same time. So it relies on symmetry of information. That's not how life works. The world is not like that, right? Right? Some people know some things more than other people, and they know them at a different time. And that's what leads to arbitrage, right? If you have a sense that maybe there's going to be a change in the market, you buy low and you sell high. That's the very nature of capitalism. You buy low, you sell high. And that's a risky event. And some people are better at assessing that risk, and they're better at determining that value at the purchase price and recognizing when it's reached a really, a nice rate of return and you can sell it. Are they sharks? Yes. Are they dragons like Dragon's Den? Yes. Is that a terrible thing? I don't think so. The difference is whether or not it's done, what's the word I'm looking for? Within the law, without insider trading knowledge. Right? So I'll give you another term, right, which is fair market value. That's usually the standard by which we write our valuation reports. We can write them to different standards, and the CBV Institute will give you a number of definitions of standards that we can use. But I like to use fair market value. And that comes down to, there's a big long definition, it's technical, and I'm not going to do that. I'm just going to say it's a buyer and a seller. They agree at the highest price at which they're going to transact. And they have good information, but it's not perfect. And it's not symmetrical, and they don't have to transact. They can walk away, and it's expressed in cash.